Gold has been on an incredible run. In 2024 and 2025, prices have surged to record highs, breaking through $4,300 an ounce, and even touching levels some analysts once called impossible. Suddenly, everyone's talking about gold again. The barbarous relic, as Keynes once called it, is back in the headlines. But this raises a question that every long-term investor has asked at least once. What if, instead of buying stocks, you had just bought gold? Would you actually be better off today? Let's take a step back and look at the numbers. In 1975, gold was around $160 per ounce. The S&P 500 sat at roughly 90 points. Suppose you invested $10,000 in gold back then. You'd have about 62 ounces of it. Fast forward to today, with gold near $4,000. That $10,000 would now be worth about $250,000. That's a 25 times return, or roughly 6.6% compounded annually. Not bad. Now let's look at the S&P 500. The same $10,000 in the index, with dividends reinvested, would have grown to more than $1.5 million.
Wow!
That's over a 150 times return. It's not even close. Gold has preserved purchasing power, but stocks have multiplied wealth. Why? Because gold is static. It just sits there. Stocks, however, represent living, breathing businesses, companies like Apple, Microsoft, and Coca-Cola, that earn profits, reinvest them, and grow over time. That compounding is the eighth wonder of the world Buffett always talks about. So on the surface, stocks win by a landslide. But let's not stop there, because context matters. There have been long stretches when gold crushed the stock market. In the 1970s, when inflation exploded and oil prices soared, gold prices went up nearly 20-fold, while stocks stagnated. In 2008, during the financial crisis, gold held its ground as the market collapsed. And recently, in 2022 and 2023, while tech stocks suffered from rising interest rates, gold quietly gained. So gold isn't a wealth generator, it's a wealth preserver. When confidence in the system collapses, gold becomes the ultimate insurance policy. But here's the interesting twist. Every time gold surges, it's usually because investors lose faith in growth stories. And right now, the market's latest growth story is artificial intelligence. AI stocks have driven the S&P 500 to new highs. Companies like Nvidia, Microsoft, and even smaller AI startups have seen valuations skyrocket. Nvidia alone gained over 200% in a year at one point. It's eerily reminiscent of the dot-com bubble of the late 1990s, where investors believed the internet would change everything, which it did. But they forgot that even revolutionary ideas have limits when priced for perfection. Now, AI may indeed change the world, but from an investor's point of view, the question isn't whether it's real. The question is whether it's already priced in. When everyone's chasing growth stories, few stop to ask, what if it doesn't go as planned? That's when gold shines. Gold is the asset people turn to when they stop trusting promises. Promises of growth, profits, or even governments. It's the anti-bubble asset. So when the world is obsessed with AI, and when valuations stretch beyond reason, gold quietly reminds investors of one simple truth. Confidence can vanish overnight. Now, does that mean you should sell all your stocks and buy gold? Absolutely not, because while gold protects against fear, it doesn't build wealth during optimism. Think about this. If you'd sold all your stocks in 2010, fearing money printing and deficits, you'd have missed one of the greatest bull markets in history.
Oh, no!
The key isn't to choose between gold or stocks. It's to understand when each shines. When optimism rules, when innovation thrives, when businesses are compounding earnings, that's when equities outperform. When pessimism reigns, when currencies weaken, when investors stop trusting numbers, that's when gold outshines. And sometimes the smartest investors don't pick sides. They simply hold a little of both. Ray Dalio calls this the holy grail of investing, diversifying across assets that do well in different environments. Stocks grow wealth in prosperity. Gold protects it in chaos. Buffett once said he'd rather own a productive farm than a bar of gold because one produces crops and the other does nothing. He's right in principle, but even Buffett quietly bought gold through Barrick Gold during the uncertainty of 2020. Even the greatest rationalist of our time hedges his bets when the world looks unstable. So, what would have happened if you'd bought gold instead of stocks? You'd be wealthier than those who kept cash under the mattress. You'd be poorer than those who believed in capitalism and compounding. But you'd have slept better during every crisis. That's the trade-off. Gold rewards the cautious. Stocks reward the optimistic. And the irony is, the best investors tend to be both. Because investing isn't about predicting the future, it's about preparing for it. The world today is moving fast. AI is transforming industries, but also distorting valuations. Central banks are printing, debts are rising, and inflation is never truly gone. In times like these, history suggests that having some gold, not as a bet, but as insurance, isn't irrational. It's prudent. But if you believe that human innovation will continue to create value, then owning great businesses through stocks is still your best path to long-term wealth. So maybe the question isn't, what if you bought gold instead of stocks? Maybe it's, what if you understood why you hold each? Because the rational investor doesn't pick one side of the pendulum. They balance both and let time do the compounding. If you found this breakdown useful, hit subscribe, not for hype, but for clarity. Every week, I help you think like a rational investor, calm, informed, and ahead of the noise.